Hi, I'm John Stover from Tribeca Investment Partners. 2025 was a strong year for global credit returns, with supportive economic growth, solid risk sentiment, and U.S. interest rate cuts helping boost returns. Asia credit outperformed other regions such as the U.S. and Europe for the second straight year, with both the high yield and investment grade indexes outperforming by about 1%. This follows an even larger outperformance in 2024, where Asia high yield bonds outperformed by about 7% and investment grade bonds outperformed by about 2%. Looking ahead to 2026, we expect Asia to continue to outperform. Asia credit offers higher yields relative to the US and Europe for the same credit rating, with the high yield index currently yielding about 7.5% compared to 6.5% in the US. And Asia, excluding China, has lower default rates than other regions, both historically and in recent years. Asia, excluding China, is the core focus of our strategy, and we continue to have light exposure to China. Asia credit is also a lower duration market compared to the US and Europe, which means it's less sensitive to changes in interest rates. This is important at a time where we see modest risk to the upside for longer-term interest rates. Asia credit also outperforms in periods of US dollar weakness, as a weaker US dollar reduces debt servicing costs for issuers and typically triggers a capital rotation from the US into Asia and emerging markets broadly. We continue to see very attractive opportunities in countries like India, where a rising middle class and supportive demographics are driving structural growth, but still offer very attractive yields for corporate bonds. In terms of default rates, we continue to see a benign environment for Asia in 2026, following a year where there were zero defaults in Asia outside of China. Asia credit already went through its default cycle in 2022 and 2023, and the surviving corporate universe is much stronger, having weathered a period of 2 years where the high-yield bond market was effectively closed for refinancing. In contrast, we think defaults in the US will continue to rise, particularly in private credit. This is likely to be driven by the relaxed lending standards over the past several years and weakness in certain pockets of the economy where loan growth was very large. In terms of interest rates, the US made 3 25 basis point cuts in 2025, and we expect the US to continue to cut in 2026, while other central banks in the region, such as Australia and Japan, are likely to hike rates, creating divergent monetary policy conditions worldwide. Our Tribeca Asia credit strategy invests primarily in US dollar bonds from Asia-Pacific issuers, so it is more exposed to the US dollar yield curve. With a new Federal Reserve chairman coming in 2026, we believe the Trump administration aims to run the economy hot, cutting short-term interest rates to stimulate the economy. However, this may come at the expense of longer-term Treasury yields, which we believe will rise modestly in 2026 as investors worry about central bank independence and global investors reallocate away from the US at the margins. Therefore, we have positioned our portfolio at the short end of the yield curve with an average duration of 3 years to maturity, and Federal Reserve cuts should benefit bond prices in the portfolio. Overall, we are very constructive on the outlook for Asia credit in 2026, and we believe it will be another year of strong returns. Thank you.